Picture this. You are 73 years old. It is a Tuesday morning. Coffee is on the counter. The house is quiet. You sit down, open your retirement account statement, and for the very first time in your life, you realize the government now decides how much money you are allowed to take out of your own account every single year. Not you, them, and the number they pick is bigger than you need, which means a bigger tax bill than you planned for, which means more of your Social Security gets taxed, which means your Medicare premiums just went up. And you are sitting there thinking, I did everything right. I saved for 40 years. I never missed a contribution. How did I end up here? Friend, that moment happens to millions of good, disciplined savers every single year in this country. And almost every time it could have been prevented, not by saving more, by saving in the right place. Tonight, that is exactly what we are going to fix, because the question is not which account makes your money grow faster. Both. Accounts invest in the same things. The growth rate is the same. The real question, the one that determines whether you keep your money or hand it to the IRS, is which account costs you the least when the money actually comes out, and the answer is going to surprise you. Tonight you are going to see exactly why the account that grows the most is not always the account that pays you the most, and how choosing the right one at the right time could be worth hundreds of thousands of dollars by the time you retire. Stay with me. This next part changes everything. Section 1, the moment most people get this wrong. Here is where almost everyone gets this choice wrong. They make it once, usually in their 30s or 40 seconds, when their employer first opens a $401,000 enrollment window. They check a box, pick a contribution percentage, and then life moves on. Kids, mortgage, the daily grind, by the time they are 58 or 62, and finally, sit down to really look at their retirement picture. The decision has already been made for them, in some cases for 20 or 30 years straight, and here is the gut punch. 2 retirees, same age, same account balance, same neighborhood, same lifestyle. One of them takes home $58,000 a year from that balance. The other takes home $41,000 from the exact same number. Not because one invested better, not because one got lucky with the market, because one of them understood which account to use, and the other one never got that conversation. That's $17,000 gap every single year is not a market problem. It is a tax problem, and tax problems, unlike market problems, are almost entirely preventable. So let us start with the basics, and I promise you I'm going to make this feel like a lecture, because the basics, when you see them clearly, tell a story that is actually a little bit shocking. Section to the tax truth, explained so you never forget it. Here is the simplest way I know to explain the difference between a $401,000 and a Roth IRA. Imagine 2 farmers, both plant corn in the spring, both tend it all summer, both harvest in the fall, but they made different deals with the taxman at the start of the season. The first farmer, the $401,000 farmer, pays no tax on his seeds going in. The government says, plant for free. We will take our cut at harvest. So he plants. The corn grows, tax-free all summer long. But when fall comes and the corn is ready, the taxman is standing right there at the edge of the field. Every bushel that comes out, he takes his share. Could be 12%, could be 22%, could be more, depending on how big the harvest is. The second farmer, the Roth farmer, pays full price for his seeds going in. No deal, no discount. But when harvest comes, the taxman does not show up. Every single bushel is his to keep, all of it, tax-free, forever. Now, which farmer made the better deal? Here is the honest answer. It depends on what happened to the tax rate between planting and harvesting. Tax rates went up. Roth farmer wins. He locked in the lower rate. Tax rates went down. $401,000 farmer wins. He deferred at a higher rate and paid less coming out. But here is what almost nobody talks about, and this next part is the whole game. In retirement, your harvest is not just your $401,000 withdrawals. It is Social Security on top of that. It is required minimum distributions on top of that. Maybe a pension, maybe rental income, maybe some part-time work. All of it's tax up on your tax return. And for the $401,000 farmer, every extra dollar at harvest can make the taxman take a bigger cut out of everything else he has coming in, including his Social Security. But here is where almost everyone gets surprised. The Roth farmer's withdrawals are invisible to the IRS formula. They do not count toward Social Security taxes. They do not count toward Medicare surcharges. They just come out clean, same dollar amount, different real value every single year. Once you see that, you cannot unsee it. Now let me put real numbers on this, because the next comparison is the one people remember. Section 3, the real wealth comparison. Stop right here for a second. Your $401,000 balance is probably not your money. Part of it already belongs to the IRS, they just have not collected yet. If you have $600,000 in a traditional $401,000 and you are in the 22% federal bracket, the government's silent share of your account is roughly $132,000. It is sitting right there in your statement, but it is not on your statement because nobody prints the IRS's balance alongside. Yours, that is not a small detail. That is a $132,000 detail. Now let me walk you through a real comparison so you can see exactly what this means when the money comes out. Meet Sandra and Bill, both 55 years old, both earn about $90,000 a year, both save $500 a month every month without fail. Same investment mix, same average annual return of 7%, the only difference. Sandra puts her $500 into a traditional $401,000. Bill puts his $500 into a Roth IRA. 12 years later, both retire at 67. On paper, their balances look nearly identical. Same amount, same growth, same time. But here is where this next part should make you sit up straight. Sandra pulls $50,000 a year from her $401,000. She and her husband have Social Security coming in about $38,000 combined. Total taxable income that year, $88,000. She is well into the 22% bracket on that $50,000 withdrawal. She owes roughly $11,000 in federal income tax, and because her combined income crossed the threshold, 85% of her Social Security is now taxable too. The bill keeps growing. Bill pulls the same $50,000 from his Roth IRA. His taxable income does not move. The Roth withdrawal is invisible to the IRS formulas. His Social Security is unaffected. His Medicare premiums stay flat. He owes zero federal tax on that $50,000. He keeps every penny. Sandra keeps roughly $39,000 after federal taxes. Bill keeps $50,000 every single year. For 20 or 25 years of retirement, run that math, $11,000 a year for 20 years. That is $220,000 in extra taxes Sandra pays that Bill never has to. $220,000. Not because Sandra made a mistake, not because she chose bad investments, because nobody ever showed her how these two accounts behave differently when the money actually comes out. Now, I want to be fair here. Sandra got something Bill did not. Every year she contributed to her $401,000. She reduced her taxable income. At 22%, she saved 22 cents in tax for every dollar she put in. Bill paid tax on his dollars before they went into the Roth. So the complete picture is not just about retirement. It is about the whole arc, tax saved going in versus tax paid coming out. And for most people watching this right now, that full picture analysis leads to the same conclusion. You want both in the right proportion based on where you are today. We will get there in section 6. But first, let me show you something your statement will never tell you. This next section is the one that changes how people think about everything they have saved. Section for 3 hidden costs inside your $401,000. Imagine spending 40 years building a retirement account, decade after decade of discipline, of choosing savings over spending, of doing everything the right way, and then discovering at age 73 that the government has already reserved a portion of it and they get to decide when you hand it over. That is not a story. That is the law. It is called a required minimum distribution, and it is the most misunderstood thing in retirement planning. Here is how it works. Once you hit age 73 or age 75, if you were born in 1960 or later, the IRS requires you to withdraw a minimum amount from your traditional $401,000 in IRA every single year, whether you need the money or not, whether the timing is convenient or not, whether it pushes you into a higher bracket or not. They do. Not ask. They require. The formula is based on your account balance and your life expectancy factor, and the amount goes up a little every year. But here is where almost everyone gets caught off guard. If you have spent 35 years loading up a traditional $401,000, you might arrive at 73 with a very large balance, $800,000, $900,000 more. Your required minimum distribution on that balance could easily be $35,000 to $50,000 a year before it even touches your other income. Add Social Security, add any pension, add even part-time work. Suddenly you have $90,000, $100,000 of taxable income you never planned for and cannot control. You are in a higher bracket than you were while working. More of your Social Security is being taxed. Your Medicare premiums just jumped because of IRMA, the income-related monthly adjustment amount, and you are sitting there thinking, I saved this money so I could have freedom. So why do I have less control now than when I had a paycheck? That feeling is real, and it is not your fault. It is a planning gap, and the time to close it is now, not at 73, hidden cost number 2. Your 401,000 balance is a pre-tax number. The actual spendable after-tax wealth you own is significantly less. At 22%, a $700,000 balance becomes roughly $546,000 of real usable money. Nobody sends you a statement showing that, but that lower number is the one that pays your grocery bill. That is the number that matters. And hidden cost number 3, flexibility or the loss of it. A Roth IRA has no required minimum distributions during your lifetime. Not one. You never have to touch it if you do not want to. It grows tax-free until you need it or until you pass it on. And when it passes to your heirs, they receive it without income tax. Every dollar on the statement is every dollar they get. A traditional 401,000 forces your hand at 73. The government sets the withdrawal schedule. You work around it. For people who want to leave something behind, for grandchildren, for a spouse, for a cause, that difference alone can represent hundreds of thousands of dollars of additional generational wealth. The 401,000 is not bad. Let me be very clear. It is one of the most powerful retirement tools ever created, but it comes with strings attached, and understanding those strings before 73 is the difference between a retirement you planned and a retirement you react to. Section 5, who actually wins with each account? All right, let us get specific. Because Uncle's next mistake costs retirees thousands every year, treating this as a permanent either-or decision when it is really a this year, this bracket question. Here is how to think about it clearly. The traditional 401,000 tends to win when you are in a high tax bracket, right? Now, 24%, 32%, or above every dollar into the 401,000 saves you 24 or 32 cents today. If you genuinely expect to be in a lower bracket in retirement, that spread is real, valuable savings. It also wins when you have an employer match. This is free money. Always capture the full match first before you think about anything else. If your employer matches 4% and you contribute at least 4%, you just earned an instant 100% return on that money before the market lifts a finger. No Roth IRA can compete with that, and it wins when you need to shelter a large amount of income. The 401,000 allows $31,000 or more per year with catch-up contributions. The Roth IRA caps at $8,000. When you need maximum shelter, the 401,000 gives you the room. Now, the Roth IRA tends to win when you are in a low or moderate bracket right now, 12% or the lower part of 22%. Paying 12 cents per dollar today to never pay again is one of the best deals in personal finance. Lock in the low rate, let it grow forever. It wins when you want total flexibility in retirement. No required minimum distributions means the account is entirely on your terms. Pull a lot, pull a little, pull nothing. The IRS does not knock on a Roth door. It wins when you already have a large traditional 401,000 balance and you are starting to see what happens when Social Security required minimum distributions and everything else stacks up in your 70s. Adding Roth money now gives you a tax-free bucket to draw from, a way to manage your income with precision instead of watching it pile up beyond your control. And it wins when you want to leave something behind. A Roth IRA passed to your children is one of the most tax-efficient gifts in existence. Every dollar they inherit from your Roth comes tax-free. Every dollar they inherit from your traditional 401,000 comes with a tax bill attached. Same number on paper, very different real value. And here is where almost everyone gets this wrong. They think they have to choose permanently, but the right answer changes depending on your bracket, your age, your balance, and which phase of retirement you are in, which is exactly what Section 6 is about. Section 6, the answer most people never hear. Use both. Here is the move that changes everything for most people in their 40s, 52nds, and early 60s. Stop thinking about this as a competition. The 401,000 and the Roth IRA are not rivals. They are partners. And when you use them together intentionally in the right order, you build something neither one can give you alone. Tax diversity. Think of it this way. You would never put your entire retirement into a single stock. Concentration in one place means one bad outcome wipes out everything. The same logic applies to taxes. If all your retirement savings are in one tax bucket, all pre-tax 401,000 or all Roth, you are concentrated in one tax outcome. No flexibility, no options. If you have money in both, you can draw from the right account at the right time to stay in the right bracket. That flexibility over a long retirement is worth a great deal of money. And here is the piece that changes the game for people already in their late 50s or early 60s. Even if you have saved almost entirely in traditional accounts until now, even if your 401,000 is large and your Roth is small or non-existent, it is not too late, because there is a window in retirement that most people let slip by without using it. The Roth conversion window. It opens the day you stop receiving a regular paycheck. It closes the day your required minimum distributions and full Social Security benefits kick in and stack your income back up. For most people, that window falls somewhere between age 60 and 73. Inside that window, your income is often temporarily lower than it has been in decades. No salary. Social Security maybe not yet started. No required minimum distributions yet. That is the moment, the quietly powerful, often overlooked moment, when you can move money from your traditional 401(k) or IRA into your Roth IRA. You pay tax on it now at a lower rate than you paid while working, and from that day forward, every converted dollar grows completely tax-free and comes out tax-free. You are not avoiding tax. You are choosing when and at what rate you pay it, on your terms, in your low-income years, instead of the IRS terms, in your high-required minimum distribution years. For many families, carefully done Roth conversions through their 60s can save six figures in lifetime taxes. Now let me show you what this looks like for a real family. Section 7, Carol and James. The full picture. Meet Carol and James, both 58, married, filing jointly. James earns $105,000. Carol earns $28,000 part-time, combined $133,000 a year. For 30 years, they did what responsible savers do. They loaded up James's traditional $401,000 because the tax deduction felt right, felt safe, felt responsible, and it was. They should feel proud. By 58, they have $680,000 in James's traditional $401,000 and $45,000 in a small Roth that Carol opened years ago but never really prioritized. One evening they sit down to figure out what retirement actually looks like. James wants to retire at 63. Carol plans to keep part-time work a few more years. Their Social Security, about $39,600 a year combined, once both are claiming their annual spending goal, $85,000, the gap they need from savings, $45,000 every year. Now here is the part that should land hard. If they do nothing different, just let that $680,000 grow. At a modest 6% for 5 more years, they arrive at retirement with roughly $910,000 in the traditional $401,000. That sounds wonderful, but here is what almost nobody tells you. At age 73, the required minimum distribution on an account that size, with more growth behind it, could force $50,000 to $65,000 out every year, whether they need it or not. Combined with Social Security, their taxable income could be pushing $100,000 to $110,000 in there. Mid-70s, higher bracket than their working years. Medicare IRMA surcharges adding hundreds of dollars a month, 85% of their Social Security being taxed as ordinary income, 30 years of discipline, and still a trap. Now here is the alternative, and this is where the story changes. Between 58 and 63, while James is still working, they redirect a portion of his new contributions into the Roth $401,000 option inside his employer plan. He still captures every dollar of employer match on the pre-tax side, but his own contributions start going into Roth. Carol opens a Roth IRA, funds it fully, $8,000 a year. Their combined income keeps her comfortably under the contribution limits. Then the move that matters most. When James retires at 63 and the paychecks stop, they use the years between 63 and 70 as their Roth conversion window. They live on a blend of taxable brokerage savings and modest IRA withdrawals, and each year they intentionally convert a slice of the traditional $401,000 into their Roth, $30,000 to $40,000 a year, enough to fill up the 12% bracket and gently touch the lower part of the 22% bracket. Why those amounts? Because Social Security has not started yet. The Social Security tax torpedo is not armed. Their income has not crossed the Medicare IRMA line. The traps are quiet. They are paying tax now, but at relatively low rates, and every dollar they convert permanently removes itself from the future required minimum distribution calculation. Over 7 years of intentional conversions, they move somewhere between $210,000 and $280,000 out of the traditional account and into the Roth. By the time required minimum distributions kick in at 73, the traditional $401,000 balance is meaningfully smaller, required withdrawals are manageable, their Social Security is taxed at a lower rate. And they now have a Roth account worth $350,000 to $400,000, producing completely tax-free income for the rest of their lives. Same savings, same discipline, same investment returns, completely different retirement. That is not luck, that is a plan. And the families who have that plan are the ones who retire with both the money and the freedom the money is supposed to buy. Your 5-step action plan. You do not need to overhaul everything overnight. Here is where to start in order of importance. Step 1. Find out what you actually have. Log into every retirement account you own. Add it all up, then separate it into two piles, pre-tax and Roth. Most people have never done this calculation. Most people have no idea what their real after-tax retirement balance is. That number is the starting point for everything. Step 2. Know your current tax bracket. For 2026, married filing jointly stays in the 12% bracket up to roughly $96,950 of taxable income. Above that is the 22% bracket, know where you sit, that tells you immediately whether contributing to Roth today costs you 12 cents or 22 cents per dollar and whether converting a slice of your traditional account is a bargain right now or not. Step 3. If your employer offers a Roth 401,000, look at it seriously. You can split contributions between the traditional and Roth sides within the same plan and still capture every dollar of employer match. This is the simplest way to start building tax diversity without opening a new account or changing your daily routine. Step 4. If you are 59 and a half or older, talk to a tax professional about Roth conversions. The years between your last paycheck and your first required minimum distribution are often the most valuable tax planning window of your entire financial life. That window does not stay open forever. Do not let it pass without a strategy. Step 5. If you do not have a Roth IRA and your income qualifies, open one this week. Fidelity, Vanguard, Schwab, any of them, less than 20 minutes. Contribute whatever you can, even if it is not the full amount, because the tax-free compounding clock starts the day you fund it, not the day you think about it, the day you actually do it. So which one builds more wealth, the 401,000 or the Roth IRA? Here is the real answer. The account that builds more wealth is the one that costs you the least in taxes across the full arc of your retirement. Not just the year you contribute, not just the year you retire, but across every single year, from right now until you draw your last dollar or pass it on to someone you love. For most people in high brackets today who expect lower income in retirement, the 401,000 wins going in. For most people who expect stacked income in retirement, Social Security, pensions, and required withdrawals all showing up at once, the Roth wins coming out. And for the majority of real working Americans between 45 and 65 who will live through both phases, the answer is both used together in the right proportion at the right time. The 401,000 gives you power today. The Roth gives you power tomorrow. Together, they give you something neither one can offer alone: complete control over your tax story in retirement, and control, friend, is what turns a good retirement into a great one. Here is the one question I want you to ask yourself tonight. If everything in my traditional 401,000 came out tomorrow and I had to pay ordinary income tax on every dollar, how much would I actually have left? And is the tax-free alternative, the Roth, something I am building alongside it? If the answer to that second question is no, now is the time to change it. You still have time, you still have tools, and now you have a plan. If this video changed how you think about your retirement accounts, do 3 things for hit that like button so YouTube puts this in front of more people your age who need to hear it. Subscribe so you do not miss the next video, where we walk through Roth conversions year by year with real numbers, so you can see exactly how much tax you can save and how to do it without tripping Medicare surcharges or the Social Security tax torpedo. And in the comments right now, type the word Roth if you want more videos on tax-free retirement strategies, or type 401,000 if you want more on maximizing what you already have. Reads every comment. Your vote tells me exactly what to make next, because that is how we do this, one smart decision at a time. I am Ethan Brooks. I will see you in the next video.